Hello everyone, greetings from Mirae Asset Mutual Fund. Historically, we have seen that equities tend to outperform all other asset classes over the long term. However, when we look at the journey is not very smooth when you approach equities from a short to medium term perspective, and that is what tends to influence the emotional behavior of the investor. Basically, at times of market exuberance or euphoria, the investor tends to invest in equities and he exits from equities at times of distress. These emotional biases like greed and fear influence and impact the returns for the investor, and the returns tend to be suboptimal. Is there a way we can address this issue? Is there a product that can lead to a better investment experience for the investor, that can help the investor ride through this volatility and provide a smoother investment experience? This is exactly what a balanced advantage fund or a dynamic asset allocation fund is positioned to deliver. Basically, these funds tend to dynamically manage the equity, arbitrage and debt portion within the overall asset allocation framework based on market conditions. Now, the underlying framework could be a model or could be based on fund managers' discretion or expertise, or it could be a combination thereof. There could be multiple factors that could be looked at while considering the underlying framework. These factors could be valuations, momentum, sentiment, risk premium, contraindicators, fundamental factors, qualitative factors, etc. Once the net equity allocation is determined, the next step is to determine how much allocation should be there into arbitrage and debt securities. For this, the overall allocation to equity is managed in such a way that overall allocation between arbitrage and net equity tends to be more than 65%, so that the fund qualifies for equity taxation. Once that is determined, the next step is to allocate the residual into fixed income securities. So this is how a balanced advantage fund or a dynamic asset allocation tends to dynamically manage the asset allocation framework, and in a way helps the investor in achieving a balanced investment experience. These funds are basically positioned to lower down the overall downside risk from equities, but at the same time reasonably participate on the upside while gaining from stability through fixed income and arbitrage opportunities. With this philosophy in our view, we launched our Mirae Asset Balance Advantage Fund 1 year back on 11th of August 2022. The fund is managed by Mr. Harshad Borawake, who manages the equity portion for this fund, and Mahindra Jaju, who manages the debt portion for this. Mr. Harshad also manages other hybrid strategies like Mirae Asset Equity Savings Fund and Mirae Asset Equity Hybrid Fund. Mr. Harshad is Head of Research at Mirae Asset Mutual Fund, and he is a fund manager. He has an overall experience of more than 18 years, which primarily includes investment analysis and research. Before we close this, would like to understand from Harshad, since we talked about the Balanced Advantage Fund or Asset Allocation Fund, what is the underlying framework that is used within the fund to determine the net equity allocation?
Sure. So the underlying framework is very simple. As the equity asset class gets more expensive, we cut down the net equity positions, and also vice versa. If it becomes slightly cheaper, we increase the equity allocation. For the model, so it's very easy to say all these things, but in practical, as you know, human emotions or biases do come into picture. So to that extent, what we have done is our model is largely a data-driven model. So we have used two parameters, price to earnings and price to book. Within that, price to book slightly has a higher weightage. The reason for that is, if you look at India as an economy, obviously it's a growing economy. So to that extent, large part of the companies are asset heavy. If you look at the benchmark Nifty 50 index, many of the weights it is towards financial companies. So to that extent, price to book is a better method to value those companies. So that's the reason we have taken higher price to book when we come to this model. Coming to model, what we have done is we have taken the last 12 to 13 years data. Based on that, we have run simulations and arrive at finally a price to earning and price to book based model. It is similar to, let me give an anecdotal example of a tree where both roots and fruits are important. So price to book is more of a roots. We need stronger roots. So for a company, we need a stronger balance sheet. Right. And from the earnings point of view, it's like a fruits where the yield for a tree is also important. So price to earning captures near term earnings expectations in the market. Also, as a fund manager, there is some leeway apart from what the model indicates. So in case there are some fundamental changes in the short term, so we can capture that allocation change.
Thank you, Harshad. Based on what you explained about the model, it is more of a valuation centric model. Do you think factors like momentum, sentiment, risk premium, others, etc. Also play a role or should be included as part of the model?
So obviously one can use multiple factors to build a asset allocation model, but for us there are I think 3 key reasons I would say why we focused only on price to earnings and price to book. One, obviously if you look at in terms of data transparency and availability, so price to earnings and price to book is obviously a much better methodology. Secondly, when I said initially we did a simulation for almost last 12 to 13 years. Right. So these 2 parameters did give a much better reasonable returns from the simulation point of view. And thirdly, I think see PE and PB both are more near to fundamental approach, the way we look at the companies from the balance sheet and income statement point of view. So PE and PB we thought is a much better. So that's the reason we are just stuck to these 2 parameters and not really confused it into or with more number of parameters.
Thank you, Harshad. Till now we have spoken about how the model works. Can you throw some light on how the asset allocation has maneuvered over the past 12 months within the fund?
Sure. So definitely I think since inception model has been quite dynamic in terms of its outputs towards net equity allocation. So if you talk from the numbers point of view, so our net equity allocation has ranged from 40% to 60%. More so if you look at last few months when the markets have done well. So we have reduced our net equity allocation from roughly 58% down to around 51.5. So to that extent I would say we are quite satisfied the way model has worked vis-a-vis the market movements in the last 12 months.
Great. So my next question to you, Harshad, is what is your portfolio construction and stock selection approach within the fund?
I think interesting question. So what we have seen over the years, so rather than taking a sectoral call, the alpha generation is more through a stock selection. So what we call it as a bottom-up approach. So any stock in a portfolio will come on its own merit. Right. So we see few things when we try to select a stock. The first obviously is the growth opportunity. There should be a decent visibility in terms of revenue growth over the next 5 to 7 years. Second is capital efficiency. It is a combination of a balance sheet and return on capital employed. Third is a management quality. And fourth is more about value in the way we value the companies. So there should be enough margin of safety. What I mean by that, the value which we assess has to be more than the current prevailing market cap. For portfolio allocation, we have a 2-pronged approach. We call it more as a barbell approach. Right. So basically at one end of the spectrum we have high quality, high growth companies, and also on the other end we do look at value names in the portfolio. And for BAF particularly, given the investor profile which we have in this fund, we have a large cap bias so as to give more stability and better experience to the investors.
Thank you, Harshad. That was really insightful in terms of explaining the approach to portfolio construction and how do you do the stock selection. Coming to valuations piece, we all know that valuations are a function of price movement and earnings. And in the recent past, we have seen how market has shot up within a very short span of time. Given that valuations have gone slightly stretched, from that perspective, how do you see the earnings growth pan out from here onwards?
I think time and again, we have seen that markets in the near term more act like a voting machine. means they are sentiment driven. But over the long term, they act more like a weighing machine. It means that over the long term, markets or market value of any company is more slave to the earnings or the cash flow it generates. Now coming to your question to this near term, the way markets have moved. So clearly, I think this year the returns have been slightly front ended. But I think just to give a context, if you look at Indian economy in the last few years, there were a lot of shocks it has went through. There was pandemic, there was sharp increase in the interest rate, then there was the inflation. So lot many things Indian economy went through. But I would say relatively it has fared much better vis-a-vis other economies if you compare. Coming to earnings, I think unlike in the last few years where only one or two sectors were contributing to the earnings, but going forward I would say multiple sectors are expected. We do expect multiple sectors to drive the earnings growth. Let's say cyclical recovery in sectors like housing, banks, auto, or even telecom is doing much better. Coming to manufacturing, after many decades, for the first time manufacturing looks promising. One, obviously China plus opportunity, and then the government's PLI scheme. Other sectors, I would say formalization, let's say formalization has done quite well in the last few years, obviously because of GST is one of the important factor. So all this put together, there is a decent earnings growth going forward. So to that extent, we believe markets are reasonable if you compare it with the earnings growth.
Thank you, Harshad. It's been a great interview so far. One last and final question to you is why one should consider a Mirae Asset Balance Advantage Fund, and who should consider this fund from a medium to long term perspective?
So in our view, this fund gives quite a balanced experience for an investor, given the dynamic asset allocation by the model in the three asset classes: equity, debt, and arbitrage. While SID does provide us or gives a flexibility to have a net equity allocation between 0 to 100, but we have built a model to have a net equity allocation between 30% to 80%. So what it does is the fund gives downside protection, also gives participation in the equities, and third is also smoothens the volatility in the markets. Coming to who should invest or who it is suitable for, I would say given the investment mandate and portfolio construct, the fund may be suitable for the investors who are looking lesser volatility than the equities, but higher returns than the fixed income over the medium to long term.
Thank you, Harshad, for those insights into the fund. Hope our users would have benefited from this. To conclude, Mirae Asset Balance Advantage Fund tends to provide a very balanced investment experience by dynamically managing the net equity allocation, arbitrage and fixed income investments, and in a way tends to provide downside protection, relative downside protection, and while at the same time also gives a meaningful upside participation through a large cap oriented equity portfolio, arbitrage investments and fixed income investments. So investors who do not want to take the hassle of dynamically managing their asset allocation and also seek tax efficient returns post rebalancing may look at this fund from a medium to long term perspective. Thank you very much. We hope you liked the video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.